We seem to have an emergency on our hands, and the emergency is not in the crypto market. It's also not in the stock market, because they actually seem to be pretty calm. The emergency that we have is actually happening right now in the bond markets. If you look at the US 10-year T-bill rate, it's back up to 4.4, 4.376. And we always said that the Fed wouldn't act unless something started to break. And it looks like the credit markets are starting to break. And I'm going to show you why the credit markets are starting to break. And I'm going to show you what it means and why this could mean that the Fed will actually be forced to act. And if the Fed is forced to act, that will probably mean that they will have to put stimulus into the system. Now remember that in previous financial crises, there was no recovery. 2008 and during the 2020-2021 crisis, the COVID crisis, the markets didn't respond until the Fed actually intervened. And we said that the markets would turn when the Fed actually intervened, and the Fed wouldn't intervene unless something broke. And it seems like right now the credit markets are breaking. So a bit of an emergency show. We're going to show you exactly what that means. We're going to show you step by step how the Fed is going to intervene, and we're going to show you when the markets will turn. If that sounds good to you, obliterate the like button, subscribe to the channel. Let's go. Big day today, because we said that when something breaks, the Fed will have to jump in and actually fix the markets. And it looks like we are getting something that is breaking. And as I said to you before, it's not the stock markets which have just opened or should have just opened. Let's see if the stock markets have opened. Here we go. That is the stock markets. Looks like it's slightly down again. S&P is down 0.3%, as you can see over here. Let's look at some of the other indices that we've got. S&P 500 down 0.25%. The NASDAQ, the NQ, let's quickly look at the NASDAQ. The NASDAQ futures are actually flat. So it's not the stock markets which are breaking. It's not the crypto markets which are breaking. This is the bond markets which are actually breaking. And you can see that when you look at the rates on the yields on the 10-year Treasury yield up to 4.36%. Then you've got the 30-year Treasury yield up for 4.8%. Now remember that we had we believe that Trump's master plan here is to force people to be so scared of stock markets that they actually cash out of risk assets and they put that money into treasury bills, and that would reduce the rate on treasury bills. And by reducing the rate on treasury bills, Trump would force the Fed to actually act and to reduce interest rates so the US could finance the debt. But it looks like for some reason the plan is backfiring, and right now the yields are actually exploding. Now, to help us make sense of this, I got Jim Bianco on the show today. Very, very, very late notice. Jim, welcome. Good to see you here.
Good to see you. Thanks for having me.
Yeah, and good to see you here on such short notice. I mean, I reached out to you. I think you must have just woken up, right?
Yeah, I'm in California. It's way early in the morning. It's 6:30 in the morning here.
Holy moly. Thank you so much. Jim, you wrote this tweet today. This is what made me get you on. So you said, something has broken tonight in the bond markets. We're seeing a disorderly liquidation. If I had to guess, the basis trade is in full unwind. Since Friday's close, the 30-year yield is up 56 bips in 3 trading days. The last time this yield rose so much in 3 trading days close to close was January 7th, 1982, when the yield was 14%. This kind of historic move is caused by forced liquidation, not human managers making decisions about the outlook for rates. What do you think is actually going on here?
That we have an inflation problem, and that the tariffs are going to create more inflation, and that we have to start to realize that in an inflationary environment, we need higher interest rates. And so much of our financial system is built on the idea that we don't need higher interest rates. And it's built on the idea that if there's ever a problem, the Fed will cut rates. It will drop to zero if they have to, and it will print money to get us out of that problem. Throughout this entire episode, the market has never come close to pricing in an intermeeting move. As a matter of fact, it's only even money that the Fed's going to cut rates in 4 weeks. In 4 weeks, it's only 52% right now that the Fed's going to cut rates in 4 weeks. And it's so the market's not even demanding that the Fed cut rates. And I think really the overarching thing is the cycle turned in 2020. We are now in an inflationary world. And the entire financial system is built on this premise that at any sign of instability, zero rates, money printing will get us out of it. And now it's understanding that's not coming. And that's why I think you're starting to see people start to reprice risk, which is why you're seeing markets from crude oil to the bond market to the stock market, having these unusual moves. The other thing I'll mention to you too is look at crude oil. Since Liberation Day, it's down 20%. Bond yields are up 30%, 30 basis points, excuse me. That's unprecedented to find a time when commodity prices were collapsing like that and bond yields were going straight up. It's just more of this kind of deleverage, forced unwinding of a market, starting to realize that we have priced in or we have assumed the wrong kind of environment.
What do you think of the theory that China is dumping US treasuries as part of a financial war, and that is pushing up the interest rates? I mean, there was news or rumors, or I'm not sure if it was substantiated, but that China dumped $50 billion worth of T-bills into the market, and that caused a spike in the 10-year or in the treasury bill rate. What do you think of that theory?
I mean, I understand the logic behind it because, they're part and parcel in a trade war. But I find it, first of all, let me back up. There are no statistics. I mean, I can't throw up a chart here. I can't share my screen with a chart to show here's what they did and how much they did. So it's all only conjecture that we have. And my comment would be, if China was willing to punish the US by selling treasury securities and driving up interest rates, then go the whole way. Dump dollars and move into a foreign currency and drive the dollar down.
But you don't think that this is a warning shot? You don't think this is a warning shot? In other words, China going, guys, be careful because you're picking with the holder of the second biggest holder of your treasuries. You don't want to pick this war.
A warning shot is usually obvious. Usually you're telling people it's a warning shot. So, come out and say it. Come out and say it. Release a press release that you did it. Dump dollars to show everybody that you're doing it. I mean, what is this? You're going to do this, but then you're not going to make it obvious. I mean, I understand the logic. I still think that this is more of a domestic move. I still think that this is more on the basis trade being unwound. And I think that, we want it to be China, but, I understand the logic. It's not fitting. The dollar should be down a lot if they were doing that trade.
Okay, before I let you go, just one more question. How do you think this resolves, and when do you think this resolves?
I think it's got to resolve in a matter of days. I don't think markets can stay like this. And what I mean by this is that these tariffs stay on for an extended period of time, and we have massively higher CPI rates. I think if I had to give you a guess, the way that it would resolve is a roadmap is needed. It's one of the more friendly countries to the U.S., Argentina, Israel, Vietnam, that's been making very, noises with Trump, cut a deal with one of them. And the deal would be perceived as a roadmap. Okay, now everybody else knows what they need to do in order to cut a deal and get these tariffs off. Let's get about doing it. And then the markets could say there's an end game there. Now, that's easier said than done. I don't know if that's going to happen. But the only other option you have is Trump capitulates. And we know he's not the kind of guy that... Yeah, exactly. So if he's not going to capitulate, then this is the only option we really have.
All right. So how much more pain? How many more months, weeks, days of pain do you think we have here in the markets?
Oh, I think we're talking about days to a couple of weeks. I don't think that, if we continue to see gyrations in markets like we've seen over the last week for the next 2 or 3 weeks, we will have some kind of financial accident. If we already haven't had a financial accident and we're just waiting for the headline to show up.
I think
the other thing I'll say about this too, real quick, when you see markets like this, and maybe I'm too online, people are asking me, who's making money on this? And the answer is nobody. Everybody's losing money. The question is, who's gone out of business? That's the real question, not who's been short at the right time and it's made a boatload of cash. And so that's why I don't think we can have markets continue to do this for much more than days to a few more weeks.
Well, I agree with you. And to be honest, I hope we're both right. Jim, thank you. I know it's 6:30 in the morning for you. And I know you woke up early for us. So thank you very, very, very much, my friend.
Thank you. Bye-bye.
All right, so that's Jim. I managed to get him on short notice to help us decipher what's going on. And for those of you who missed the first part of the show, what we are seeing is we're seeing something breaking, not the stock markets, but we're actually seeing the government, the bond markets breaking. The yields are going up. Now, as Jim mentioned, we're not 100% sure of exactly what's going on here. There are a couple of theories. Remember that Trump's plan is to get the 10-year or the treasury yields down, the interest rates down, so that the Fed is forced to reduce interest rates. Now, speculation is that China, because, and I love this photo because, Trump wrote the book, the Art of the Deal, so to speak, and you've got the Chinese president, Xi, reading the book. But China may know or do know that is what Trump is trying to do. And as a result of the fact that they know exactly what Trump is trying to do, they are the biggest holders of US Treasury bills, right? Or the second biggest holders of US Treasury bills. And so there is speculation that China may be dumping Treasury bills into the market. Now, when you dump Treasury bills into the market, effectively there's so many Treasury bills out there that in order to entice people to buy Treasury bills, you need to lower the price. And the way to lower the price is to increase the interest rate on these T-bills. And that's exactly what's actually going on. And so right now we have carnage in the markets, in the treasury markets. You've got every single T-bill rate actually going up. I showed you guys the 30-year, I showed you guys the 10-year, but every single yield is going up, right? Which means that people are dumping US treasuries. Now, who could be dumping? It could be China. It could be hedge funds that are actually being liquidated at the moment, because there are a lot of these hedge funds which are effectively long treasury yields and leverage long treasury yields. And when things like this happen, they could be getting liquidated. So we could be getting a liquidation effect happening right now. That's Nick at Coinbureau says, no, it's not China dumping US securities. It's over leveraged hedge funds whose basis trades are blowing up. Warning signs as there was a big spread between the T-bills. So that's another one of the theories. There's another theory out there that a major Japanese bank just blew up, and in order to pay its obligation, it's starting to sell its T-bills. Either way, whatever is going on here, it's not good for the Fed, right? Because it's not good for the US. You don't want to be in a situation where everybody is dumping your T-bills, because then that means that interest rates are going to go through the roof. And that is very, very, very unsustainable. It's very, very, very unhealthy and unsustainable, and it needs to resolve very, very quickly. Now, here's a theory about how this could resolve. Someone says there's a current liquidity event going on. As people speculate, someone is blowing up or something systematic is breaking here. Now, in terms of all the selling, someone has to absorb the selling. Now, in terms of who could absorb the selling, there are really four parties that can buy T-bills. The one would be the Fed. The second one would be US commercial banks. The third one would be foreigners. And then the other one is pension funds and insurance funds. Those are effectively the only buyers in the T-bill market. Let's analyze the buyers here. We know that number 3 right now is probably not buying any US Treasury bills, because we're in the middle of a trade war. And the last thing that you want to do in a trade war is be buying your adversaries' bonds. Like, that's not going to be happening. That brings us to local buyers in the United States. So who are the local buyers in the United States? Insurance funds, pension funds, and money market funds. And that's possible. They could be buying T-bills. But then you've got two other buyers, and both of them are around the Fed. And so the one is the Fed itself. And speculation is that if this dump continues into US T-bills, one way or the only way to fix the markets is that the Fed actually buys the T-bills themselves. If the Fed does that, that's a kind of stimulus, because effectively what would be happening is you would get the Fed saying, look, we need to salvage the markets. The only way to salvage the markets is to buy these T-bills that are on the markets. When the Fed buys these T-bills that are on the markets, effectively they put more dollars into circulation, and that is seen as a kind of a QE, which is actually happening. And so he says only two of them are price sensitive buyers. You guessed it, the Fed and the US banks. Now, the US banks have a SLR requirement, which is a constraint in terms of how many T-bills they can buy relative to the capital that they're holding. But in the past, there have been exemptions from SLR. In other words, that is when the Treasury tells the banks and says, look, you can actually, instead of having to hold X amount of T-bills relative to the capital that you've got, you can actually hold a whole lot more T-bills. And so right now, we are in a scenario where if the Fed want to save these markets, if we want to get the markets done or resolved in the next couple of days, somebody has to step in. Otherwise, we risk many consequences, such as potential liquidations, people being unable to potential liquidations of funds, people being unable to take debt, people going bankrupt. So the situation kind of has to resolve itself. And right now, it feels like the Fed may actually have to step in. The reason why this is exciting for us, and I'm not the only one who says this, by the way, today Deutsche Bank came out and said if recent disruptions in the US Treasury market continue, we see no other option but for the Fed to step in with emergency purchase of the US Treasuries to stabilize the bond market, and basically another situation where we get emergency QE. The reason why I'm saying emergency and QE with a happy face, and this is my happy face, by the way, for those of you who don't recognize it. Andre, this is my happy face, right? Very, very happy. The reason why I am so happy about this is, and you shouldn't be happy when there's an emergency, is because I said for a while now that this market would resolve when the Fed actually steps in. And it's the same scenario of if you look at COVID and if you look at the 2008 housing collapse, you'll realize that the markets only started to recover when the government or the Fed actually stepped in and started to take action by, in both cases, in this case, QE and putting more money into the economy. And I tweeted the other day, and I think I'll go and find that tweet just so we can all be on the same page. I did tweet the other day, although the interns usually mess up my account here, but they do. You can see they just tweet all the time. I said the last two panic crashes, 2008 and 2020, the pain didn't stop until the Fed actually acted. And the question is whether that is going to be exactly the same as what's happening today. And so now we need to wait and see what the Fed's move is. One of the things that we should keep our eyes open for is that tomorrow we have an inflation reading, a CPI reading. And I mean, this was sent to me by the guys at Trueflation. They said Trueflation is forecasting a decline in the CPI reading for March with an annualized increase to 2.5% year on year. Now, you'll remember that the previous reading was actually 2.8%. So they are forecasting that the inflation reading will actually come out lower today. Anyway, so that is what's happening in the bond markets, and potentially the Fed is going to start stepping in. Let's talk about what's happening in the trade war, because I think that is the core of everything that's going on here. So in the trade war, you get some companies, I mean, to quote Trump, don't ban my video on YouTube because Trump is the one that said, he said, companies are kissing his ass.
Because I'm telling you, these countries are calling us up, kissing my ass. They are dying to make a deal. Please, sir, make a deal. I'll do anything, sir. Because I'm telling you, these countries are calling us up.
So I want you to remember this video because we're going to talk a lot about this video and how the market actually resolves here. But the trade war continues, and the face that the US is putting on is that everybody is kissing their ass to actually make deals. But there is one country that is not kissing the US ass to make deals, and that is China. Now, listen to this video and just look at how Chinese this video is.
You said that China would take resolute actions in response to the new tariffs that have just come into effect today from the United States. Can you give any specific examples or any specific measures that will be enacted by China? Also, President Trump has said China is, quote, desperate for a deal.
另外，特朗普总统称中方非常想达成一个协议，这是真的吗？
reciprocal like-for-like tariffs on the United States. Thank you.
中国是否会不再采取报复性的、针对性的措施呢？
美方仍在对中国滥施关税，一味地进行极限施压，对这种霸道霸凌行径，中方坚决反对，绝不接受。美方如果真的想通过对话谈判解决问题，就应该拿出平等、尊重、互惠的态度。如果美方是两国和国际社会的利益维护，只以打关税战、贸易战，中方已经奉陪到底。
is determined to fight a tariff and a trade war, China's response will continue to the end.
So, very, very simply, what China is saying is, look, you may be able to bully a whole lot of other countries because they're small and they're inconsequential, but we're not that. We are one of the world's leading suppliers. You need us as much as we need you. By the way, we also hold a whole lot of your T-bills and we will dump them at any point in time. We're going to carry on fighting this fight. And that is the clear message that China is actually saying. China is effectively saying to the US, listen, treat us like humans, treat us like partners. Don't bully us and just blanket. If you think that something is wrong, come and sit around a table with us and let's resolve this so that we can get to some kind of place where we're both happy. But this approach of bullying us into submission is not going to happen, right? And so right now you've got all this going with China. China says, look, they're prepared to deal with any uncertainty that is actually happening there. And I mean, they've basically said, for every punch that you throw at us, we're going to throw a punch at you, right? So the Chinese minister said, okay, you imposed an additional 50% tariff on us over and above the 34%. We're going to match you 50% plus 34%. We're going to impose additional tariffs on US goods. So they're not, and at the same time, it's like two big boys throwing punches at one another. I mean, I want to use a very bad example, but it's like when the parents are going through a divorce and it's the little kids that basically, it's like the parents fighting in front of the kids. These are the two strongest countries in the world and they're fighting and everything else is pretty much collateral damage, right? Now, like you'll realize the extent of this fight. We impose tariffs, you impose counter tariffs. We then hit you with financial warfare. You then talk about removing our Chinese stocks from the US exchanges to cause what you're trying to do here is you're trying to cause a mass exodus of people from Chinese stocks, therefore reducing Chinese stocks. And so ultimately now there is a massive war that's going on. And I want you to listen to this clip with Tucker Carlson and Scott Bessent because I think it's super important.
You want to sell to Americans, you got to make it in America.
Sure, or pay the tariff.
So how is China as a nation going to, I mean, this is such a big challenge. It's directly in their face. It's about every country on the globe, but it's really more than any other country about China, I think it's fair to say. How are they going to respond? What's their retaliation look like?
Well, I don't know if they can retaliate for a couple of reasons. If you look at the history, and I used to teach economic history, and when you look at the history, we are the debtor nation.
Yes.
We have the trade deficits. The surplus nation is in the weaker position because the Chinese business model, and Tucker, by the way, the Chinese business model and the economy are the most imbalanced in the history of the modern world. We've never seen anything like this in terms of their export level relative to their GDP, relative to their population. So I think it is going to be very difficult for them to try to change the model. They're in a deflationary recession /
Oh, okay. So that's pretty much what's going on. There's a game of chicken that's actually going on. And as Chamat says, he says, the question is who's going to win here? So it could be that the Chinese, that the US win. It could be that China win. Chamat thinks that as many problems as the United States has, China is actually worse. He says China is seeing the slowest growth they've had in decades. Their attractiveness as a recipient of foreign domestic investment has come to a halt. And they have a demographic problem of too many old people. They need exports, therefore they will blink first, right? Gholoik says, let's look at both sides. In China's favor, they know that the US has to roll over their debt, and therefore they need yields to come down, and they can stand in the way of yields coming down, as we've seen. They also know that this has to be resolved by the time the midterm elections happen, right? And that means that Trump is under time pressures. Also, he says the Chinese can culturally, they're the world champions of enduring hardship, which I think we know the US is not the world champions of reducing hardship. Whilst the Chinese continue to manufacture, the US are complaining about that the tariffs are making it a lot cheaper to make our chocolate bars. That's what Mr. Beast is saying. I mean, Like, you can just see the difference in culture. What the fuck? The US flies in 5 planes full of iPhones. Like, that's how, like, it's just a different culture, right? So I think the lawyer's got a thing here. It says, now, things in the US's favor. China needs to fight deflation. They've already got a lot of debt. They're net importers. So they have an advantage over exporters. China needs the exports. USA can make trade deals with countries that net export to the US and net import from China, where US tariffs are dropped if those countries put up tariffs on Chinese imports. So the US can now do a multi-party or through-party negotiations. The CCP doesn't really want to see civil unrest, and the US has geographical control of many canals and shipping routes. So net, he also thinks that the US actually wins this game of chicken. But the reality is that I think that what's going to happen here is that they're just going to eventually start negotiating, because this can't carry on. It's not good for either party. No one wins here. This is like one of those wars where no one wins. The US doesn't win, China doesn't win. And so I think both parties actually have an incentive to go to the table. And I think what Trump did was a little bit crazy, because what he did was he hit everybody with tariffs and he's starting to negotiate. And now I think he's starting to realize that China is not good to negotiate. They're going to have to sit down around a table with China. And this is where my thesis is going. These things have to resolve themselves. And I think they're going to resolve themselves pretty soon. And the reason why I think they're resolving themselves pretty soon is the following. One is things are breaking on the bond market, which is not good. You can see that. 2 is, if you look at the markets are displaying crazy behavior. One is the S&P keeps jumping off this thing here. By the way, did you know that yesterday the S&P was up 4% at the peak but closed in the red? Do you know that I think that was the biggest reversal ever that the S&P's actually had? On a points basis, the S&P just posted its largest intraday reversal in history. That was yesterday. The third thing is that the VIX is above 50, which is in the top 1% of historical readings. And that's, like every time that you look at what's happened in the VIX being above 50, just look at that chart over here. Every single time that the VIX has been above 50, look at what has happened 1 year forward, 2 year forwards, 3 years forwards, and 4 years forwards. So everything's posting to a massive recovery. Also, generally, peak panic is when every asset class sells off. So if you get real panic, and we saw this in COVID, and we saw this in the 2008 housing crisis, real panic is when people just exit all markets. Like, they exit gold, they exit oil, they exit stocks, they exit bonds, they exit the NASDAQ, they exit everything. And that is pretty much where we are at the moment. This is what you call peak panic. The fear and greed index. Let's just quickly look at it again. We did look at it yesterday, but let's quickly look at it again. 4! Bro, 4 is like 0. Yeah, it's going to go to 0. So you got fear and greed going down to 4, right? That is absolutely crazy. You got oil. Look at this for the oil chart. Oil is a great barometer for how positive people are about the future and how scared they are, right? When oil goes down, it's generally because people believe that manufacturing is going to slow down and people are going to stop spending. Oil is down. Look at oil. Oil is down from January. Oil was at 81. Oil is down at 60. Do you know how that basically knocks inflation? And remember, tomorrow we have the inflation reading, and it looks like it's going to come down. Even gold, I mean, it is a little bit up today, but it is actually going down. This little candle in the gold market basically shows me that the panic is almost over. This is the candle I was looking for that says, when people are very scared, they exit all markets. When the peak of being scared actually passes, then what you start seeing is people go into the safe haven assets, and that's exactly what's happening right now. Also, I don't know if you guys saw this morning, but there was an emergency meeting to hold a meeting, and this is an emergency meeting at 4 p.m. Japan time on Wednesday. And one of the things that they actually want to discuss at this meeting is to consider providing stimulus. This is a Chad move by Japan, and I'll explain to you why this is a Chad move by Japan. Japan knows that in response to these tariffs, people are going to order less Japanese goods. As a result of the fact that less people order Japanese goods, they know that the Japanese economy will suffer. And so what they're doing is they're giving the Japanese people 40 to 50,000 yen per citizen. That's a stimulus. That's pretty much as much as a stimulus check. Let's quickly see what 50,000 yen to USD. I don't think it's very big. It's $350 per person in Japan. So they're talking about a stimulus of giving everybody in Japan a stimulus. Now, here's the Chad move by Japan. This is also a move of financial warfare against the United States. Why? If they give people money in Japan and they give stimulus to Japan, what will happen is the Japanese inflation rate will go up. If the Japanese inflation rate goes up, the only way the Japanese can slow that down is by increasing the interest rates. If they increase their interest rates, the Japanese yen cash and carry trade begins to unwind, and that will knock the US stock markets because a lot of the Japanese money is invested in US stock markets. So you got to look at this. Is this important what you've just sent me? Oh, Trump's telling you it's a great time to buy stocks. You see, Trump, so he is watching the stock market. This is a great time to buy. DJT. I agree with him. I agree with him. Never bet against the Fed. Never bet against Trump. Never bet against the Fed. This is a great time to buy. Let's see what Trump's... Okay, S&P up 1% on Trump's advice. Let's say it's financial advice. You should phone Trump and just say, bro, like generally when we say that, we always say this is not financial advice. Anyway, so this is the Chad move by Japan because the stimulus is coming. All right, next. So we got that. Bottoms are usually choppy, and we can see a lot of the retest of the lows. The S&P 500 VIX closes above 45% for a third day in a row. That's usually a sign of a bottom. Trump is giving zero chance for the markets to recover. They said we have a very clear time frame. It will be a very busy April, May, maybe into June. They're literally giving you the time frame, maybe into June. That came out of Scott Beston's thing. Raoul Paul says, I spoke to him yesterday actually on WhatsApp. He says, this feels a lot like December 2018 for those who were around. Powell signaled a pivot. I think we get the same. Plus a trade resolution with China. Risk in stocks feels 10% the downside max versus 15% the upside in 2 weeks and 25% in the upside in a month or two and much more in 6 months. I think it's time to buy. I think it's time to be buying. This is the thinking for me. If stocks go down, 10% left. But if they go up again, there's 20, 25 up. Let's see, stocks are up. Stocks are up. Yeah, stocks are up. S&P 1.5% up. Trump's giving us financial advice that we should be buying. So we need to start buying. And I think I agree with Henrik here. And I think this is what we're going to see. The reversal is going to be one for the history books. We're going to start seeing a massive reversal in the bond yields, and we're going to start seeing a massive reversal in the markets. And so I think it's time to start buying. But the big question is, what do you start buying? So let's talk a little bit about how to buy in situations like this. In situations like this, unless you're a cowboy and you're really, really, really playing with like excess money, which I know no one actually has excess money anymore because, like no one has crazy money to take risks with. In situations like this, you're not looking to make the maximum return. What you're looking to do is you're looking to make the maximum risk-adjusted return. Now, let me explain that concept to a lot of people who maybe don't understand that concept. Of course, if you buy things like Fartcoin and whatever else, of course, if the market pumps, those things could go up the most. The thing is, when you're dealing with investments, you don't invest like that. When you're dealing with investments, what you got to look at is you got to look at, say, minimize your downside, manage the downside, and let the upside take care of itself. And so you should invest as if the market will continue to go down, but be okay or be good if the market goes up. Now, if the market continues to go down, so let's maybe just work a little bit on that adage that says, invest as if the market is going to go down and hope the market actually goes up. So the question is, what would you hold if the market was going to continue to go down now? You would hold the safer assets. And so what I would say right now is you can probably start buying, but you should buy things that are the safer bets in the market. Let me give you an example of some things that I would be looking to buy right now. So number one, I'd be looking to buy Coinbase. Reason why I'd be looking to buy Coinbase. And again, a lot of the stuff in fact, could you put a markets.com link below? One of you. Okay, so why Coinbase? Look at Coinbase. Look at where it is. Look at these levels. It's at $159. It means that we've gone back almost 1 year in Coinbase's history at $158. That's something that I'd be looking to buy right now. I'll give you something else that I'd be looking to buy right now. Tesla. I'm looking to buy Tesla. Why? Look at where Tesla is relative to its high, and look at where it is relative to the first time that we actually got these prices. I think it's 2021. It's over here, 2020. We're back to 2020 levels. So again, I'm giving you a buy list, and it's not only a thing. What I'm looking to buy right now, I'm looking to buy maximum risk-adjusted returns. Coinbase, MicroStrategy, Tesla. Let's quickly look at MicroStrategy's price. Let's see, 250. What is our price here? 254. Okay, so those are the. I'd be looking at buying those stocks. I'd be looking to buy Bitcoin here. I'd be looking to buy Solana here. I'd be looking to buy Hyperliquid here. I'd be looking to buy Sui here. I'd be looking to buy Sonic here. I'd be looking to buy Grass here, because those are all real businesses. When you're buying these businesses, you're not taking excess risk. These are all tokens that will be here next cycle and the cycle after and the cycle after. And therefore, if you're going to start buying, this is the type of buy list that I'd be buying now. I wouldn't be going into crazy meme coins, and I wouldn't be going lower down the risk curve yet, just in case there's another hit down. If there is another hit down, you're pretty safe if you landed up buying these tokens, right? Do we have the markets.com link here, Josh? Let's quickly just get it quickly here. I want to just show you this. The reason why I say the markets.com link is because you can actually trade stocks. Let me just log in quickly, just to make sure that my 2FA is not visible here. So let me just see if we can actually log in here. Remember that I am using South African internet, but I am also using a VPN, so there we go. Okay, so the reason why I use markets.com, and there will be a link for those of you who want to use it, you can actually add money in crypto and you can trade stocks using crypto. And I think in these kind of markets, there's so many opportunities in the stock market. Like, Coinbase is going back to 300. MicroStrategy going back to 400 at some point. And so you want to be buying in this kind of market. And so again, like MicroStrategy, Coinbase, Tesla, these are the things that I'd actually be buying. And then I'd go into my crypto portfolio and I'd be buying things like Bitcoin, Hyperliquid, Solana. It's the first time that I've actually had enough conviction to give you guys an actual buy list and say, you know what, I'm ready to buy. And the reason is, I think something's about to break. And I think the worst is over. And I think that if you're not deploying in times like this, then I have no idea when you would actually deploy. So that's my thinking. Let me know in the comments what you think. Rob James says it's not time to buy it. Adrian Creel says access to your list as displayed. I mean, Frontrunner's got this access a long time ago. Can we put the spreadsheet in the show, please, Josh? Josh, I'm giving you lots of homework here. By the way, we do need to select a winner. Remember in our BitUnix competition, right? Remember, for those people that sign up with BitUnix, we have, we're giving away $5,000 every single day for people that sign up. So if you want to do it, just go sign up. You don't need to do KYC, which means even if you're in China and big trade war going on, you can do it. So generally, you can sign up to BitUnix. You can sign up to markets.com. Sign up to BitUnix, and we're giving away $5,000 every day. Today, we are giving away the $5,000 to this number over here. 882-241-157. That is the username. That's the username. If that is you, email giveaways@cryptobanter.com, and you're going to get $5,000. And if you want to sign up, just go and do it. Lastly, I want to thank you guys, and I actually want to commend the guys that actually run Bitfunded. So I've been using their platform for a while, and first of all, the experience is absolutely amazing. Second of all, they are now the largest prop trading firm in crypto, and that means that they've just got a very, very, very good offering. The offering is amazing because basically what lands up happening is that you invest, you put $99 down, and then you get like a $10,000 demo account. And if you can get 8% in the first and 5% in the second stage, then you're trading on their money for free, and you actually keep 90% of the profits. Now, the reason is I'm so proud. I met these guys when they were an absolute startup, and we made a little investment in this company. And I'm so proud of what this team have actually managed to achieve. They're like the fastest growing business in crypto. So if you haven't already checked it out, go and check it out. And if you take out an account today in the next 24 hours, I'll give you one for free. I'm paying for the free one. So just go slowly on me. Go easy on me. Anyway, I shall see you guys again tomorrow. Hopefully it's going to be a better day. Until then, trade well, my friends.